Tēnā rā koutou katoa, nau mai haere mai ki tēnei hui mō te kaupapa o te rā Progressive Home Ownership Risk Management. E karakia hau ki a tātou, kei te timata o tēnei hui. Tūtaua mai I runga, tūtaua mai I raro, tūtaua mai I roto, tūtaua mai I waho. Kia tau ai te Māori tū, te Māori ora, ki te katoa, haumi e, hui e, tāi ki e. Ngā mihi nui ki a koutou katoa, kei te haere mai koutou I tēnei hui. Thank you all for joining us today to listen and ask questions around risk management and mitigation strategies to support you entering into progressive home ownership. Our karakia this morning was to bring on the elements that surround us, from above, from below, from within, and the essence of the universe to enrich our kōrero for today. So hopefully that blesses us with great conversation for today. Ko wai ahau, ko Elizabeth Richards tōku ingoa, he uri ahau no Ngāpuhi me Ngāti Tūwhare Toa, no Horeke ahau. Kei Tāmaki Makaurau, taku kāinga I noho ana. He kaia ki ahau mō te Tua Papakura Kāinga, the Ministry of Housing and Urban Development. My role here today is to facilitate the discussion with our panellists and to propose any questions that you may have with them. Today's session, we will discuss the considerations necessary for managing risk when delivering a PHO scheme. During this webinar, you'll hear from staff within Te Tua Papakura Kāinga, from the Bank of New Zealand, and also from our providers. In preparing for this session, I've asked our panellists to consider three factors. However, it may be a bit wider than that conversation. The three factors that I've asked our panellists to consider is around the development risk. If you're looking into housing, into being the housing developer, what are the elements that you need to consider around cost, consenting, construction, etc. I've asked them to consider the finance risk, so that's you're becoming a borrower but also a lender to the whānau. What are the risk factors you need to consider around this? For example, as it's a loan, how do you align this with your other mahi that you're doing? And how do you protect yourselves in order to repay that loan? And the third and final one, which is quite an important one, is around relationship management, and particularly when working with the whānau, noting that you are having to rely in some respects on the whānau repaying you in order to repay the loan, but it's also around the balance and how do you balance that relationship so that you're not being intrusive on the whānau whilst also supporting the whānau. Today we have three panellists with you today. We've got Nigel Hewitson, who is coming from Te Tua Papakura Kāinga. He's the commercial manager within the PHO team. We've got Rachel Woodhouse, who's a senior partner within the BNZ, who will talk to you about what the bank looks at when they're assessing the loans. And we've also got Dominic Foote, who is the CEO at the Housing Foundation, who will talk to his experience in delivering a PHO scheme. And I actually personally wanted to thank you, Dom, for all of the support that you've provided to Te Tua Papakura Kāinga and the development of the PHO scheme. I'll ask each of them, as I ask them to speak, to introduce themselves when I hand over to them as well, so they can give a small little bit about their background and then go into their presentations. We did have a fourth panellist, and unfortunately she's been unable to make it today. However, she did do her homework, which is great. So I will talk in some respects to her presentation as it comes through, and then we'll see if any questions and stuff that the rest of the panel can go through and answer. So kia ora koutou, I hope you all enjoyed today's presentation around risk management. I'm going to hand over now to Nigel Hewitson, who, as I said before, is the commercial manager for the PHO scheme within Te Tua Papakura Kāinga. Kia ora, Nigel.
Kia ora, Morena. Tēnā koutou, ko Nigel Hewitson aho. I'd just like to start off by saying that there's all sorts of different definitions for risk, but I like to think in terms of the sort of project risk, where the definition is around an uncertain event that, if it occurs, has a positive or negative effect on a project's objective. Dumbing it right down, I had a project the other day of in the morning to cycle for about 45 minutes along Tamaki Drive and over the hill and back home again. And there were all sorts of different risks that take into effect, and they could either be quite small, They could be risks that are very likely to happen but have a low consequence, or something that could take a unlikely to happen but could have a very high consequence. For instance, it was looking pretty showery and rainy. Well, that's a low consequence risk, and I was quite happy to accept that. I could have been cycling along and seen glass on the road. Well, I could avoid that, but the consequence of it would have been a bit annoying and time delaying, or even the serious risk of being doored as I drove past a line of cars. So the mitigation that I take on all those situations is, particularly on the dooring risk, is moving out into the middle of the road and avoiding the chances of not being seen by somebody opening their car door. So there we're just looking at the different risks we all face every day, and the different things we do to mitigate those risks, and assess them and the consequences. So going into the PHO space, as a provider, the risks that you consider is, how does it, when you're considering whether to take up a loan with PHOs, how does it impact our financial position from the provider's perspective? How are we going to repay the loan? What additional risks would it add to our business model? So these are all the things that you'd be going through your mind. And yes, you're creating an asset, but it comes with liabilities. From our perspective at Te Tuapapa Kura Kāinga, when we're considering the funding proposal, our questions are around, well, what's the Crown's risk on making this loan? And what's the risk to the Crown if the loan isn't repaid and there's a default? And how can we manage and mitigate that Crown's risk if that event occurs? And so that all informs the security that we're considering, and whether that security is adequate for the particular circumstance of that loan and that project. So looking at the organisation when we get the application, it's important to consider the organisation's mission and vision and strategy. Is it clear that the organisation is really engaged with the delivery of progressive home ownership, and they've set up in their governance and leadership and decision making to deliver the project? And are the internal operations and management of the day-to-day operations fit in with that providing a PHO product, as well as all the other work that you're doing? And we also look at the process of selecting the whānau, because the risk around selection processes and being fair and transparent is something that's very important, and also to get the right whānau for the right product that you're developing. The financials, we're obviously looking for a sound financial position that the organisation has. We're particularly looking at solvency, liquidity, the ability to cover your day-to-day debts as they come up in the normal course of business, and then the ability to access funding to meet the contingencies that may arise in the course of the business. So then into the other risks for Te Tuapapa Kura Kāinga is around the management of the monies. We want to ensure that the money is actually going into particular parts of the required by the loan agreement. So if you're acquiring a site, it's actually to help the acquisition of the land itself, and then our lock-up releasing money during the course of the development is staged against either the lock-up when the house becomes watertight, and on completion. So there are different. So we want to ensure that the money is going to be managed by the organisation, so there isn't a risk that it could get intermingled and lost in other operations. So the organisation's experience with delivering PHO products previously is very good and helpful. And if the experience isn't there, then what are the how are we meeting that risk of getting the experience brought on board and to help the whānau and help the delivery of the project. Around the product is another area which we look at carefully, and here the risk is whether the product is still sort of in development and whether the organisation is still sort of undecided of the detail around the terms of the agreement with the household, and so we are looking to see that the documentation is all in place, that it's been that it's sort of accepted in the financial community. The different products around rent to buy or shared equity are well exposed to the market over many years and are accepted by the financial institutions. When you move away from the draft, the sort of the standard terms and conditions of those types of agreement, then you introduce uncertainty with the banking sector, and that can be a risk to getting the product, the whole project off the ground and funded for the benefit of the whānau. So we look for the completed documentation, so there's no ambiguity about what the how the household is going to work with that product, and we also want to ensure that it's legal and meets legal requirements, and that you have a bank who's going to work with the organisation and the households to provide finance at the appropriate time, depending on what the product is. Is the risk workable for? Is the product workable for your whānau? Does it meet the sort of the payment requirements to get through to build up equity to buy the property at the end of the rent to own period, or is it going to be possible with the modelling that you've done to see that the whānau will be able to purchase the balance of the equity in the house from the provider in year 5, 7 or 10? From the modelling is an important element of assessing the risks around your particular product and your whānau, and so we look to see that those risks have been tested in that modelling, and the sensitivity tested as well by using different assumptions, so that you can look at what the chances of different types of risk will have on the whānau being able to get to the position that they need to get to. And as we've heard in the previous webinars, the support to the households is critical to the success of the PHO schemes. And in fact, with shared equity and with the rent to own programs, they rely, the loan repayment to the Crown relies on the households succeeding. So the whole program needs to be geared towards nurturing the households and walking beside them on the journey. That's a really important area of risk mitigation, to ensure that support is available and continues to be available. And we have a grant facility as well as a loan facility to help with that work. It's really another area of risk is the delivery plan to obtain those eligible homes, which are going to be used for the whānau, and it has a very wide range of risks depending on how the homes are going to be built. I mean, we're going into a period now where there's a change in the housing market, and we're starting to see it now. And over the course of the next 12 to 18 months, we can expect hopefully prices will be slowing down very much so, and maybe reach a point where there'll be a bit more in equilibrium going forward. So we've got restrictions on the amount that banks can lend for low equity loans, and there's controls being introduced around debt to income ratios. So these are all things that are affecting the market. So the range of securing those homes can be quite low risk, where you just purchasing a property from a developer, it's complete, you just need to acquire it, through to turnkey, 10% deposit down and completion on the balance of the monies on completion, through to the really high risk areas of land acquisition leading to development of the land, the subdivision of it, and then the construction. So the level of risks around that route range enormously, and for even for a very seasoned and experienced developer, the risks around that are medium, I'd say high actually, very high, depending on particularly depending on the size and commitment and time and cost to delivering those houses. And so for the inexperienced, I think you just have to clearly recognize your capability in the area and whether there's a capability gap, and then ensure that you get the best advice available, and stay 100% engaged and track the identified risks and action the mitigation strategies early. So in summary, my takeaway points are that leverage off the experience and the assistance of others. Don't reinvent the wheel. Use the tried and tested. Recognize the risks that could lead to default, and demonstrate how those risks are mitigated or eliminated. Thank you very much.
Kia ora, Nigel. Thank you very much for that. And I'm glad that you're able to navigate Tamaki Drive on your bicycle in the mornings, because I know at times navigating it in a car can be quite a challenge. So it was great to see the takeaways that you've taken, and talking about the risks that Te Tua Papakura Kāinga looks at when assessing a provider through its application process, and how that provider can demonstrate their risk mitigation strategies. Just one part I have for you in relation to your kōrero was around what are the risks that Te Tua Papakura Kāinga are looking at in relation to the security that's been provided from the provider?
It's around the repayment of the loan, and there's a variety of security we can take over the property, and normally we're looking at a mortgage, and that could be backed up with a guarantee from a parent company or a financially sound third party as a guarantee, and there are sort of three other types of security that can be looked at, and that's a general security agreement and assignment by way of security, or transferring the provider's interest in the asset, in the homes, to the Crown in the event of a default. So those are in our guidance documents and in the ITP that we have, those are explained there, and then each situation is considered in its own context and merits of that particular application.
Kia ora, Nigel. Thank you for that. So I'm just going to move now into Rachel. Rachel, as I mentioned before, is a senior partner within the BNZ. Rachel, I just ask you to introduce yourself a little bit more comprehensively than what I have, and then go into your kōrero. Just noting that the one pātai that I have at the moment is in relation to how can banks help tūpuna whenua trusts build houses on papa kāinga whenua. And I'm assuming that means Māori land, as well as perhaps non-Māori land that is building papa kāinga, for the benefit of mutual trusts and beneficiaries. So if you can think about that as you're doing your presentation as well, that'd be great. Kia ora, Rachel.
Kia ora. Tēnā koutou katoa. Ko Rachel Woodhouse toku ingoa. Ko Aotearoa. Whakahaere mātua mō te whanganui o Tara. He kaimahi aho no te piki o Aotearoa. Tēnei te mihi, kia koutou, o te aho tahuhu, no reira tēnā koutou katoa. Kia ora, everyone. My name is Rachel Woodhouse, and I'm the Senior Partner for Wellington BNZ. I look after commercial and business bankers, so they're looking at the larger requests that we have, but I'll talk more about that. So I'd like to take this opportunity to thank all involved in Te Ahu Tahuhu, the Progressive Home Ownership webinar series. So the Bank of New Zealand recognises the important mahi and is committed to progressive home ownership. I've seen a significant increase in the number of whānau groups approach the BNZ for various progressive home ownership projects. And I've worked with various groups from whānau to large iwi, all with various ambitions. These have had a range of funding grants, loans, private beneficiaries, and so a very broad mix. And I know that the group on the call today are really range in terms of their activities. So I'll try and speak in very general terms, but happy to take more specific questions as they come up. So as a bank, we generally think about risk as cost. Yes, we are that blunt. So anytime we're creating a risk, we're creating a cost, and then there's an impact. So we really need a full picture of any project to enable us to understand the risks. And the three fundamentals that we consider when looking at lending are people, security, and the ability to service any residual debt. So let's start off with talking about people. So I'm going to start with the group initiating a project. We are really interested in who's involved, and we will want to understand their experience in this kind of project. We've got a wide range of groups that approach us, so we are looking to understand, have they done a similar project before? Do they understand the time commitment that might be involved? And are they engaging the right external experts? This is particularly if a group is getting into development work, there can be significant costs in getting this wrong. But regardless, there are contracts involved and families involved, and there's some really big risks for everyone. If everyone in the group undertaking a project has a day job, do they really have the time to put into this project? So if we're looking at development, what additional experts might be coming in, and are they already engaged? So when we're thinking about external experts that the bank's really interested in seeing, we're wanting to make sure that you've got good solicitors. So this is around right at the very start, making sure you've got the right structure. I've seen many groups have had to re-look at trust deeds and actually set themselves all up again and cancel and close other trusts. And significant work, significant cost, and can be quite challenging when there's many people involved. So well worth trying to get that sorted up front. The other aspect is we've seen many groups have started off perhaps as an operational provider, and then moving into development. And again, they'll need to set up different legal entities. So there's some big work to be done there. And it's worth asking around to ensure that you've got experts who have done this before. You're also wanting to make sure that you're future-proofing your intergenerational assets. So we want to make sure that there's good advice there and that you're thinking about that. And of course, there's going to be many contracts potentially to look at, including our own, HUDs, or wherever else, and also understanding the impact. So we heard Nigel talk earlier around security. The bank will take security, potentially other groups will as well. You need to understand the impact of that and what the contracts are asking. One of the other experts, particularly if you're undertaking development, will be a quantity surveyor. And these are great at really understanding a whole another range of risks. So their role is to overview the building contracts. They're making sure that the risk is shared and doesn't just sit with you. So they're looking to ensure that you're getting good product and pricing, and they'll have a good understanding of the current market. Unless you've been under a rock for the last 6 months, you know that there are massive supply chain issues, and these are not going to be resolved anytime in the next couple of years. So you're wanting to make sure you've got good advice around what product is going to be available and that you're able to manage and negotiate costs. We're seeing an increased number of contracts where there are increased amounts of not fixed price. So previously, you could get a lot of fixed price locked in. You're seeing a lot more of that. People try and shift that back to the group undertaking the project. And you're wanting to make sure overall that the feasibility is right. Does the ultimate cost to deliver the product, is it worth what you've put into it on completion? So really being able to make that decision and then decide if what you're doing is the right thing. So once we've looked at the people, and we do look at them, we then look at security. So when a bank is lending for a project, the security, and really Nigel's covered this quite well, so I won't go into a lot of detail here. We're wanting to understand how we can secure the project. And of course, we'll need to understand if there are other people who have an interest in the security to understand how much we can lend against it. So we've already covered a large number of types of security. I won't go into a lot of those. Yes, we can lend on Maori land, but what we can lend is less than what we could lend on a freehold fee simple land, for example. That's not everything though, and Nigel's already raised, there might be other assets out there that we can consider as well. And I think what I would say here is these are very much case by case. Every single one of these that I've looked at, and I've probably looked at 8, are very, very different. And so it is worth having a conversation to see how we can make something work, and we're very open to that. Yes, we do look at lease land as well. That's something else that's come up. And we can look at various side agreements. So I've got one example where a benefactor is gifting a significant amount of the project, both in terms of the end building. And so in that scenario, there are different things that we will consider. So if you are brave enough to take on an actual development, and I would say that this is generally at the larger end of town in terms of organisations who've been established for some time and have really built up their credentials, and I've been really impressed with one of the iwis I've worked with in terms of their ambition, but the work they've done to build up to get to this piece. There are some other things to consider. There is some real benefit in purpose building, the ability to build what you want to ensure that longevity and ensure the latest technology and to create the space you want to create is fantastic. It is risky. It is a very specialist area of banking, and because once you're building more than 3, generally that will come into a commercial development. So there's going to be more rigor from the banks, which is not a bad thing, commercial terms, and certainly, more risk involved. A number of groups have decided to go down the turnkey option, and that's where you're purchasing something pretty much it's been purpose-built for you, but you're buying it once it's already built. And that can be a good way if you don't have the expertise in development. So if you are building, I just want to raise a couple of risks here that you need to be mindful of. Engineering work required to get, you'll be just to be mindful of how significant that is, including things like civil works. And we had one conversation last week with the client, and they were in the mind of, do they, once they've developed these roads, are they going to give them to the council, which then enables public thoroughfare, or do they want to keep the roads to themselves? There's a lot of additional questions to consider. If you are building, really understanding what's going to be covered in terms of money coming in and thinking about the size of units. There are some restrictions in terms of what banks will lend against. We're not that comfortable with apartments under 50 square metres, though having said that, we'll make an exceptions if it's part of a larger development and we can understand. There are some additional risks in terms of time delays. We've already talked about supply challenges and manage the cost overruns. Every delay is cost. Right, so now we move on from security to servicing, and Nigel's talked about this a bit as well. So we are looking at the ability to service the bank debt and other debt. Assessment for anything takes time, and the residual debt does depend on a number of aspects in terms of what you've been able to put into a project, what else we've been able to consider. So grants versus loans, where we've had a grant come in and it is not repayable, so we have seen some of the Kāinga Ora ones, that really does mean you've got immediate equity in the property, which does enable, once we do our calculations, a more likely ability to lend against the rest of the project. For loans, we'll need to factor in the servicing that is required from the other party. So even if it's over a period of time or due in several years, we need to factor that in. We also need to understand if there's an operational subsidy coming in. And some people are now considering whether they use another provider again to do that for them, especially if it's a smaller group going into it. I really think all of the projects I've seen, there's been some element of partnership. And I think that is a great way to use experts and those that have done it before. With regard to whānau lending and understanding, so again, you might be contributing some, and then they're coming in. And Nigel's covered a lot of these already, but definitely the selection process. Where I've seen it done well is where groups have used another third party to ensure the wraparound services. The bank is set up where we have specialists who help assess. The reality is, we're not set up to ensure that people grow their financial literacy to save and budget at the level that's probably required. And there is some work to be done to ensure people can have the ability to service remaining debt. So anyone buying in, so a family moving in, they will be subject to normal lending criteria. However, there are ways where we work with groups to make sure that, they would have a good understanding of our criteria up front and be able to kind of be working to that. And where there is the shared equity, because that's in there already, you've got a lower amount that they're needing to service, which makes a big difference in their ability to get there. The other thing, and Nigel's touched on this, is making sure that that you've thought through what happens when it goes wrong. Does the organisation have the ability to step in and support? I've seen some of these that have been done kind of as side agreements, so we haven't necessarily been wildly involved, but we've seen how they're doing it, and they've got family that are involved ready to step in, which is good. So look, I think Nigel's key points were very similar to what I would say. I would stress that, there are multiple scenarios. This is all case by case. It's very specialised. Engage early. Do keep your bank updated. What might seem trivial to you may significantly change the application process and structure. They are significant deals in terms of complexity and risk. And, in all honesty, it comes down to understanding the people involved, the ability to secure some property or other security against their debt, and then how do we service the income at the end. Thank you.
Kia ora, Rachel. Thank you very much for that very insightful conversation. So just taking my summary as such from what you've presented, Rachel, is that it's important to have great support and understanding of those who you're working with. So that can be your solicitors. I picked up quite a lot around your discussion around your quality surveyors and how they can help you to share that risk, to have that good relationship with your builders, etc., and understanding and how to share the risk and develop your PHO scheme. And that's what the bank's looking at when they're assessing it. In relation to the question that was asked around borrowing on whenua Māori, so Rachel said that they can lend on whenua Māori. However, the level of security that is provided then impacts the amount that can be borrowed. So it's just taking that into account that that we know that with whenua Māori that there's the inalienable elements of that, and therefore the security can't necessarily attach to the land, so it has to attach to something else. There was another question just in there that I've got for you, Rachel, was I suppose it's a comment that was made in some of the questions is it time for the banks to investigate ways to work with Māori freehold title whenua? I think you have answered that to some degree, but also just how that might look in your view, just an initial view of how that looks with the PHO.
Yeah. Look, I think there's two things. One is some of that is legislative restrictions, and I get the impression that those potentially will be changing. So that's helpful. We do work with some really large iwi, and the way that we do that is around leasehold. So they, have a small lease that people have for the right to occupy, if you like, but we lend against the actual house, and so there are ways of doing it. I think there is this is still very new for us as well in terms of actually getting some of these off the ground, but we are definitely willing, and we have head of Māori Business Development who works very closely with us, and with any client that I work with, comes on board and shares his examples of where he's worked. Look, I think this is an area that we will come under and more pressure to do more.
There's one last question here that's come up for you specifically, Rachel, and it's around can your bank fund multiple builds on trust whenua of say 10 house build project?
Yeah, it's a really good question. I'd initially say, look, case by case. We have done two significant builds in Wellington where we've done We've already done one that's over 10 and there will be another. So it is possible. It comes down to some of the structuring of the deal and how it's going to be. So if you're going to retain all of them in that group, then that is possible. If you're going to have them all yeah, it becomes a bit of a concentration risk in terms of numbers. So depending on how many, if they're going to go into shared ownership, then potentially there's a limit there. And what you'll find is when you're applying to the scheme, often you'll have to apply with multiple banks in support, and that kind of covers some of that as well. So I don't know if that's the easy answer, but yes, it is possible.
So whānau, the next presenter was going to be Mata Turner. Mata Turner currently is employed by Kāinga Ora, but prior to her role with Kāinga Ora, she was working with Waikato Tainui and managing their housing proposals. She has done a presentation for you, so I'm going to ask Kirby to share the presentation, and then I'm just going to briefly go through them. I'm not going to talk to them in full. I'm just going to go through them very briefly. There's an overview of the development that Waikato Tainui did in central Hamilton. So they were looking at 50 homes marketed to first home buyers who were registered tribal members, whose income was below the income caps that they'd set. And whānau needed to also be approved mortgage, to come with a pre-approved mortgage. So prior to actually going through this, I know that with Waikato Tainui, they have a program that can support whānau into understanding the requirements for becoming a first home buyer or a mortgage holder. She talks to the price point and understanding the affordability of the whānau, noting that there was actually quite a lot of interest. So over 300 people responded to their expression of interest. However, only less than 5% were able to progress through because of the affordability of the homes. So we all know that the cost of housing is increasing, and it's trying to find that right point. And the other risk that she noted in her presentation there is just around finding the right builder to partner with and getting that builder to understand their cost margins and their profit margins and how that can be shaved to some degree to support whānau into affordable houses. She talked about how they needed to change during the process. So it's being agile to pivot as challenges are faced. So they had to change the product that they were looking at partway through and partner with others to go through and do that. And then what Marta talks to was just in relation to the key takeaways. So the key takeaways for her in working with Waikato Tainui in their development was around ensuring that you understood the affordability of the whānau that you're looking to support, finding the right build partners, those who can work with you, and also having the ability to pivot and shift and change as risks and things like that come up that they needed to manage. I didn't give that presentation as much heart as I'm sure Mata would have done, having lived and breathed it for probably a good 2 years while she was working with the tribe. But I do know that it was successful. There are whānau sitting in there working in it. They did work alongside the Housing Foundation, who we've got Dominic Foote coming up shortly, and also Habitat for Humanity to support that activity. So again, it's coming back to some of the conversations that Nigel raised, and how do you manage risk as a provider? The comments that Rachel raised around working with the people, understanding the people that you're working with, and are they on the same kaupapa as you, and then going through and understanding the whānau. So I'm going to now hand over to Dominic. So Dominic, if you could just give yourself a bit more of an introduction. So Dominic is the CEO at the Housing Foundation, and as I alluded to before, was an important cog in our wheel in developing the PHO scheme and providing the insight and advice that you did. So I'll hand over to you, Dominic, now. Kia ora.
Kia ora. Thanks, Elizabeth. That's very kind and very generous of you. Kia ora koutou, ko Dominic Foote toku ingoa. I'm the CEO of the New Zealand Housing Foundation. We're a smallish not-for-profit whose primary purpose is to assist whānau who are renting, low-income whānau renting, transition into home ownership. And we've developed over the last 14, 15 years 2 products that we think have sort of shown their worth through the evidence of whānau transitioning into full ownership. And those products are shared ownership and also rent to own. And our rent to own product moves people from renting into a rental situation. At the end of that renting situation, they're then able to buy into shared ownership. So everything we do is about transitioning and assisting whānau into ownership over time. So everyone's described risk, and so I won't stay for too long on this slide, but basically it is something bad happening. How do you mitigate that? How do you define risk? What do you know that risk looks like? What's your knowledge of risk? If you're doing something new, your knowledge of what risk comes with that new item, that new product, is going to be quite minimal. So what I'm trying to do here is not follow through the development program, because I think what Nigel and also what Rachel have done is highlight to yourselves what risk looks like for development, building houses, working with banks. My focus here is more around whānau, and as an organisation, how we engage with whānau and how we ensure through our engagement with whānau that we're mitigating for whānau more than for the foundation risks. Their risks are being in shared ownership, their risks are being in rent to own. Because if we can help mitigate those risks, we're also actually mitigating our own risks. So, you know, it's a mutually sort of assured benefit, this. And also, as Elizabeth said right at the start, you can look at risks at so many different angles. So what I've chosen here is to look at risk quite crudely from a pre-settlement, i.e. before the whare through shared ownership is purchased by whānau, and then once whānau are in their shared ownership home. But I think one of the things that's come through the earlier slides has been capacity, capability, experience. You've really got to ask yourselves, do you know your strengths and weaknesses when you're going to enter into a PHO program? Do you know really, truly what you're good at, what you excel at? Do you know your gaps, your shortfalls? It is so important to understand those first, because it doesn't stop you from doing PHO. But what it does do is point to where you may need to partner with someone to help you through the PHO program. And the Housing Foundation really does anything on its own. We do almost everything in partnership with organisations, iwi, community organisations, Pacifica groups. Everything we do is a partnership approach, because we know that we're not good at everything that we do. We know where we're strong. We know also where we have gaps. Also in partnering, you learn. You learn through partnering. It is really important that partnering isn't just a contract for service. Partnering is actually where you collectively start to engage and learn from what the other entity is doing. So having understood that, we then sort of really work out, what is the housing need? What is the final demand for housing? What does it look like? How many are there? Who are they? Can you describe them? It's always the first question I ask my teams is, can you describe who's going to be in those whare? What are they? Who are they? What can they afford? Is shared ownership the right outcome? Should it be rent to own? Should it be affordable rental? Let's understand. And then also, what are the numbers are we talking about here? Is it 1? Is it 10? Is it 100? Is it 1,000? Because that then starts to give some focus around what it is that you're capable of doing, and also not overcommitting. So understanding demand, you then start to think about, well, what's the land? What's the whenua? Is it available? Can you access houses? Can you buy houses from a developer? Do you have to build houses? So you've heard the risks from Rachel and from Nigel about construction and development. And one of the strengths of the Housing Foundation is we do develop. We've built about 1,000 houses now over probably about the last 14 years. But we still enter every development with a degree of trepidation, because we know that the getting it wrong at the development stage is actually a big cost to the foundation. So we also then have to look at our reserves, and we're going to do this. Do we back ourselves that we're going to come out at the very least at a break even, if not with a positive margin? The other aspect to it is that whilst we understand need, and if we're going to do shared ownership, we need whānau to buy at least 55% of their home. So is that possible? Is there enough income to service a mortgage that enables them to buy with a deposit 55% of their home? Is that viable? These then start to really focus what you can do and what you can deliver. When you are looking at whānau borrowing capacity and capability, credit history, savings, source of income, stability of income, they're really important. Banks will look at those first and foremost. That's the first hard line test that banks will take. So you have to take that test. You've got to really be sure that when you're working with whānau, that they are themselves capable, because they've got good credit, they've got savings, they've got a solid source of income, that the banks will actually be able to tick that box quite quickly and say, aye, they are eligible at the first step. It's also fairly pointless saying to someone, shared ownership works for you. whānau need to get to that point themselves. They need to be aligned that actually what you're proposing works for them. If you don't get that alignment at the start, there will be problems later on. You really need that alignment. So you need a bit of talk, communicate. The amount of time that you spend at the front end before you even think about how you design and build a house is really important. It's also important when you're working with whānau around the alignment and their eligibility that once they've been mortgage approved and you're at the point where you're ready to buy the whare, whānau are ready to settle on their purchase of their equity, that they're still actually eligible for that mortgage. We have experienced whānau who have got to the stage where they've gone to draw the mortgage down, and the banks have said, no, sorry, not lending to you. We've gone back over your last 3 months of statements and you've actually borrowed more money, you've taken on more debt, or your income has changed, you cannot service that mortgage. That is a really hard position to be in because everyone is expecting whānau to be in the whare. Absolutely. And what we've had to do, and this has then come at our expenses, we've actually then rented that whare to the whānau. We've had no choice. We've had absolutely no choice. But at least we've got the capacity to do that. Admittedly, that happens rarely because we have enough systems in place around staying engaged with whānau, but that is really, really important. The ability to transact at settlement. And then the last two things really is as you've heard from Nigel, you actually need to make sure that you can repay the loan. So you do not want to get to a settlement stage where you're buying the house, buying the land, setting it onto whānau, and then drawing your money down from the PHO without a plan for how you're going to repay that PHO loan. Because it is a debt, it is due. I mean, they say there's nothing more certain than life and taxes and death. Well, actually paying debt is also fairly, is a certainty. So all of those talk to that final point, your responsibilities and liabilities. Do you actually really know them? It's not like an Apple contract where you sign up your phone and you just tick, yes, I understand all the conditions. You do really need to understand the contracts that you're getting into. So assuming everything's gone well, and trust me, 95% of the time, it goes well. You know, I'm flagging the risk. When you know the risk, it goes well. Whānau in the home. Your job's not done. In fact, if anything, your job's actually just started. You have to commit resources to work with whānau through 15 years. You have to allow for a 15-year period. We're finding whānau are actually transitioning out of shared ownership into home ownership after about 7 to 8 years. That is, they are buying our share in their whare from us after about 7 to 8 years. We also know, though, house prices rocketing up, household incomes not increasing so much, that ability to buy out early is probably going to go further and further back in time. So it's more likely to be a 10-year, a 12-year. Could even be in times to come that they'll take 15 years to buy us out. But you need to be in there. You need to be on that journey with whānau all the way through. And in being in that journey, you'll know very quickly if whānau lose income. So what do they do if they've lost income through redundancy or through a disability or through sickness? What do you do if they can't afford to make their mortgage repayments? And the bank says, well, you can't pay your mortgage. We want our money back. We're going to sell the house. What do you do then? So through our shared ownership agreement that we have with the banks, including the BNZ, is that we're committed to actually buy the whānau's equity to preserve their credit history and also to preserve the house to stop it being sold. That's quite a large liability, given that we already have a PHO debt in there as well. So that's a risk that you have to manage, and that's a risk that you can't actually foresee because, as I said, you know, managing additional whānau debt, life happens. It does. I mean, no one can predict the future. We're married today, we're single today, we don't have children today, we have children tomorrow, we get divorced, we die, we have a disability. Stuff happens. It just happens. So how do you cope with that? How do you manage? And one of those things that does have that impact is whānau taking on debt because they need a replacement car, they got to repair their house, they want to do something. How do you manage that? So the importance of having that is actually staying alongside whānau, having that very open door, that open conversation with whānau around their circumstances. So we meet with whānau at least once a year, and we meet with them as often as we need to for the duration of the time that we have funding our money in their home. And often we'll meet with whānau more than once a year, it's often twice a year. And when they are in difficulty, we have an open door policy. We'll be there as long as they want us, and we'll work with them to help them get back in on the path that they're on to own their first home. If I haven't purchased our equity from us after 15 years, what do? Well, you've got no choice. You've got to repay the PHO debt. You just have to. So we ensure that we actually have enough money set aside on our balance sheet to cover the debt. We also work on the basis that we work on a percentage. We look at the amount of whānau that we will be housing with PHO, and we'll make an assumption that a percentage of them will not transact and transition into home ownership, full ownership, and buy our equity after 15 years because of life circumstances. So we set aside funding for that. So we know that we're going to cover that. Other things that you need to be aware of, we expect whānau to pay house insurance, council rates, repair the home. And if their home, our equity is effectively, we're like a mum and dad as far as we're concerned in that sense. We'll leave the funding in there at no cost to them, but we do expect them to take on the responsibilities. But if they don't pay the house insurance and the house burns down, what happens? You've got a debt that has to be repaid, but there's no house there, and you've got a whānau who's actually homeless, or the house is significantly compromised for some reason. So you need to stay on top of insurances. You could take the insurance liability on. These are things that you can choose to do and how you mitigate risk. So there are things that you can do and you can manage where you can put the liability and the responsibility onto whānau, because when they own the home outright, this is part of the protocols, the responsibilities of home ownership. And then you've got other things that you need to consider. And these have to sit within your own policies, your own thinking, but also be mindful of the PHO responsibilities. One that we frequently get is, I need to move down country. Can I rent my whare to whānau member? And we'll take a view on that, depending on the duration and the length. If it's for 6 months, we'll often let that happen. If it's for longer, then no, we won't. Because the benefit of PHO for that whānau is for them to own the whare that they're in. It's not for them to rent it to someone else. It's a very hard line, and it causes us a lot of angst, but we do take a view on that. But these are things, this is our policy. This is the Housing Foundation's policy for how we mitigate some of these risks. You may not see them as risks, but it's for you to have a clear understanding when you move into running a PHO program of the things and the questions that you could be asked, with the circumstances that you could face. So I've talked about some of these items as I've gone through some of the risks. Our number one focus is pastoral care, because if we get it wrong, then it's badly wrong for whānau, and that ain't going to happen for us. We're not going to put whānau in a bad space. So for us, it's about understanding need, affordability. Then that helps us determine what is going to be the best PHO product for whānau. And frequently, shared ownership is not the solution. In fact, often rent to owners and then transition to shared ownership. But we also know for some, shared ownership absolutely works, but you need to be sure about that. Partner with banks. Rachel said, banks would take a view on the number of mortgages in a development that they will issue. So most banks cap out at about 25 to 30%. So if you've got 20 houses in a development, you'll need at least 3 to 4 banks to partner with to provide mortgages. Because a bank may say, okay, 20 houses, we'll mortgage fund 7 of them. Who's going to mortgage fund the other 13? You need to then find 2 more banks to do that. So you need more than one bank onboarded. And the onboarding means that the bank has to accept you as a partner in the shared ownership program. Because when you do shared ownership, whānau take the mortgage out from the bank, but the bank will look at the other property owner, which is the Housing Foundation shared ownership. We're on that title of that property. And they'll say to us, you got mortgage liability. Because if we're putting a mortgage over the whole house, you as the title owner have a mortgage liability. Now, we're not liable for the repayments. We're not liable for any financial misconduct, misappropriation, any additional debt whānau take on, but we're liable because if there is a mortgagee sale, bank sell, they can instruct the sale of the property because as a mortgagor to the bank, we've given them the rights to do so. So you're going to be really mindful about what shared ownership means in terms of your liabilities when you partner with a bank and when you actually then whānau come into a home. That's why it's so important for that journey with whānau from the day that they settle to the day that they transact, buy you out and move on. We've had, in all honesty, nothing but brilliant service from the banks. The banks, when they understand shared ownership, they buy into it. They understand the outcome. Crudia could say it ticks all the ESG, CSR sort of boxes, but actually it goes deeper than that. Banks are truly committed. So when they look at risk, what they're doing is not just protecting themselves, but they're actually looking at yourselves and saying, do you actually understand the risk? Because we don't want to cause harm to you. We don't want to affect your reputation, because we do have to take steps. The other thing that we also find is that law firms and other services, shared ownership isn't known. Very few legal entities know shared ownership. Kāinga Ora have done a very good job promoting their shared ownership program through the country, and that's certainly going to help the understanding of what shared ownership does. But if whānau got limited income and they go and talk to a lawyer, and the lawyer doesn't understand shared ownership, before you know it, the whānau legal bill could be $3,000 or $4,000, quite simply, just because they'll charge on time. So the foundation partners with law firms, and those law firms give a commit to a fixed fee. And part of that fixed fee is doing things like wills and other benefits that enable the whānau, when they've got an agreement to buy a property, that actually the whole of the whānau are supported. And then for us, the main thing is that no one goes into a shared ownership home or a rent-to-own home in the foundation without a financial plan, and that financial plan varies depending on the household, on the whānau. Because some whānau are absolutely fully get everything, and all they need is some sense of direction as to where they need to take their money and go forward, in the sense of what do we need to say, what do we need to earn, how do we do this. Others need a lot more. They need a lot more support. And that is why often for some whānau that they could take 2 or 3 years before they're ready. But it's important to invest that time. And the financial plan helps guide people. It helps guide in terms of the direction. And then sort of the main thing for us, because we are a developer, and with whānau, we really want to make sure that whānau know the house price when they buy it. So we actually fix house prices. And we have been caught, obviously, because values have gone up, but we've fixed prices for whānau to buy a house at 700,000. On the day of settlement, the new valuation shows it's 750. But that's to the whānau's benefit. But we've fixed the price early because we actually know that what they can afford to buy, and the PHO lending that we get covers the cost of that house at that price. Pastoral care, do never underestimate it. Please, just don't. I know for yourselves, this is something that you would do through so many of your other services. And I think that's really important. You provide pastoral care. Most of the organisations at iwi, Kapapa Māori organisations on this call, would be doing this anyway. But just because it's ownership doesn't make it any less important. It doesn't. And that's the third point. PHO, shared ownership. PHO for me, and that one is actually shorthand for shared ownership. It's different to renting. You are just a passive equity owner in the whānau whare. It's their home. You actually don't have control. You can't kick them out. You can't terminate tenancies. You can't hammer on the door and say, hey, you have none of those rights. You actually give a lot of rights away, which is why understanding need, pastoral care, relationships are so crucial for shared ownership to work. Kia ora and thank you.
Kia ora. Thank you very much, Dominic. Very insightful kōrero, and it's great to hear how important it is to understand the whānau need and build your product or service to suit the whānau need rather than trying to retrofit the whānau into what you're providing. It's also good to hear that you do have to have hard conversations at times and understand how you can support the whānau through those hard times and things like that they might have. What is something that Housing Foundation does, or what are the things that Housing Foundation does in relation to building those partnerships with other providers to support them into supporting whānau through home ownership? And also, are you looking at going into the outer regions of Aotearoa? One of the questions was from Tairāwhiti as an example. So yeah, just a couple of questions there from the participants.
So I mean, this is from the Housing Foundation perspective, but there are other community housing providers that do also partner. Habitat is a good example of an organisation that partners through the Rohi, so through the Mutu rather. They are, so when I talk about the foundation, I think you should also, anyone who's listening to this, watching this, should also think about other CHPs in their community, like Habitat, who do the same. Housing Foundation's partnered with Ngātahu, Waikato Tainui, Port Nicholson Block Settlement Trust. We're working alongside Te Tai Whenua at Heratona, just to name a few. And we operate so differently with each of them. We do different things. So in some of them, we will help through the construction and the development. We'll provide development expertise, and in others, we just work purely with whānau. Some of them, so we work with the Māori trustee as well. Some of them we will actually take on the full responsibility and role of the iwi in delivering the housing services to whānau. Others will sit right in the background and support that iwi can do the job. And what the decision that is made is not made by us, it's made by the iwi or by the Māori community housing organisation. So they'll lead us as to what they need. And that's the first point. It is about coming back to the very first point. What are the strengths and weaknesses in the organisation? Once we got that right, then we know where we can slot in and support. One of our most enduring aims is actually that we want the capability and capacity and the strengths to be built in other organisations. The need for ownership and affordable housing is massive. Housing Foundation can't do it on its own. Kāinga Ora can't do it on its own. You can only do it in partnership. So I absolutely would encourage anyone who's interested in this, contact ourselves, contact Habitat, and we will work to find out what we can do with yourselves. In terms of elsewhere, we are looking at other areas. So we are looking at the Hawke's Bay, we are looking in Bay of Plenty, we are based in Christchurch, Canterbury, Tairāwhiti is another place. Taitokerua, at the moment, no, though we have worked with iwi in the last few years, but there's nothing concrete there for us to work with. So I guess what I'm saying is we're game for working where we can. Providing household services is something that we do. It's a core competency of ours, and we want to help others succeed.
Kia ora, Dom. And just reiterating the comments that you said, I've worked with a few iwi in my time and noted the work through this mahi that you've supported them with, and also Habitat for Humanity as two working examples, but noting that there are others out there that are happy to share knowledge. Queenstown Lakes, for example, is another one that's very happy to share knowledge that they have there. So whānau, there's a few of you that have questions in there in relation to partnering. What I would suggest is that through the PHO scheme, if you're interested in looking at, there is information in there to contact us, and I think the email is pho@hud.govt.nz. And we have two PHO leads. So Debbie Bean is the PHO lead for Te Ao Taketake, which is our Māori and iwi pathway. And we've got Mark Ormsby, who's the lead for what we call the provider pathway. And both of them can work with you to see what your aspirations are in relation to providing PHO. And if you're at a point where you're looking to partner with someone else, they can introduce you to other people as well. So I've answered those questions, hopefully, in that. So we've now come to the end of our presentation from our panelists. There are a few questions in there specifically, they're quite specific questions in relation to banking. And then just one question that I might ask of both Dominic and Rachel, and Nigel, feel free to add if you've got any comments. Is it mandatory to take out mortgage insurance to possibly mitigate these unforeseen life negatives? I'll probably start with you on that one, Dominic.
Oh, that's a difficult one. We do recommend it to some whānau. We recommend it depending on whānau circumstances. If it's a single person applying, then we would strongly recommend. Often you get circumstances where you may get a single adult with children, and then in that circumstance, we'd absolutely recommend mortgage insurance. You can't, you can't sort of demand it, but you can recommend it. Where there's more than one income coming into the household, because our mortgage payments are based on 30% of gross household income, then we'll look at the total income from the whānau and actually sort of work out how suitable or how able would that whānau be able to support with just one income the mortgage debt for a short term. So it's not a hard and fast, it's whānau by whānau really, but I guess the one essence is if it's a single person, single income, then we strongly recommend that they take out mortgage insurance.
And Rachel, is it a requirement from a bank perspective?
Generally, yes, but even beside that, I'll be honest, if it was any of my own family members, I would be absolutely adamant that they needed it.
The other question that's coming through, and this is again for Dominic and Rachel, but I might start with Rachel first in this one, is in relation to tiny homes, transportables, security and things like that. What's the bank's approach to supporting or financing for tiny homes? And then Dom, would you consider it through the PHO scheme?
Right. So if we're talking about one tiny home for with nothing else there, then the answer is no. If it is part of a bigger portfolio, then it is possible. But the thing is, with a tiny home, you can pick them up and take them away. And when we're talking about security, we very much prefer landed or something that you can actually get your hands on, I suppose. So yeah, it's unusual, but it can be considered if you had a large group who already had additional other assets and security, then we can consider it.
Yeah, at the moment, the Housing Foundation view on this is no, mainly because tiny homes tend to get more than one tiny home on a section. And often with the cost of housing, the price of the section is actually what drives up the cost of home ownership. And my experience and my views, and I'm well prepared to be tested on this, is that shared tiny homes, you'll get more than one tiny home on a section. So the question would be then, who owns the section? Is there a lease associated with that tiny home? How do you do shared ownership on that basis? It becomes slightly more complex and difficult. But that's our position. But if someone's there and they're interested in tiny homes and how that works, then I'll be quite happy to talk with them at a later date.
Kapai. Nigel, I saw you came off mute. Did you have a comment on that?
No, I think really only around sort of the longevity of and the well-being of living in a tiny home for a long period of time. I mean, so you balance that against other quality, size of house, etc. in what your outcomes are. So yeah, that was the only comment I'd have.
I just wanted to, I suppose, wrap up the conversation today and thank you all for taking the time to attend the session. From the volume of questions and things that we got, I think a lot of people got a lot of information out of today in identifying risks and managing risks that we have in relation to the PHO scheme. To our panellists, I want to thank you all for your knowledge and expertise on this kaupapa, and I took a lot of information away from what you've provided today. I thought your insight was extremely valuable around the various risk areas. As I noted at the beginning of the conversation, some of the questions that I wanted you to focus on was what are the risks around development, understanding the finance risks, but to me, the most important one is the working relationship and understanding the needs and requirements of the whānau. So thank you all for your kōrero today and your presentations. So again, thank you all for your time today. I will close us with a karakia. So the karakia is to hold fast to our conversation that we've had today and return yourselves to everyday activities as well. So ka whakairia te tapu kia wātea ai te ara, kia turu ki whakataka ai, kia turu ki whakataha ai, haumie, huie, tāi kie. Kia ora rā whānau. Thank you very much.